What's up everybody, GICS Dividend Investor here. In this video I show you some fascinating new dividend information about the SP500 that I doubt you've seen anywhere else, so I encourage you to watch this whole video. But first I wanted to shout out my latest channel member who just joined up, so thank you to my subscriber named Truth. I really appreciate your support. Okay, let's get into it. I recently reached out to SP Global, ticker SPGI, to ask them for some information about an article they published, and I got in contact with one of their senior analysts named Howard Silverblatt, who shared some really awesome dividend data with me. Near the end of this video I'll show you some useful data on SPGI, so I recommend you stay tuned for that. But first here's a quick clip of Mr. Silverblatt from a couple months ago, talking about what he thinks will happen in the markets this year.
What does your crystal ball say for 2024 for all those Main Street investors out there?
Well, two answers, obviously, as usual. One's historical. In a presidential year, the market typically goes up nicely. Typically not always in the first quarter, and the last 20, 30 years around Super Tuesday it goes down, but the year is good. A couple reasons for that. The people in power want the economy to be good, because while the market's important, politics is important, beliefs are important, pocketbooks are a lot more important, especially when you're going to vote. So typically they make sure the government is good.
Howard has been with Standard & Poor's since 1977, i.e. almost 50 years, and has received numerous industry awards, most notably for his work on the creation and development of Standard & Poor's core earnings as well as the GICS sector names that we all use. Howard said, and I'll quote, "If you're getting up there in age, as I am, you are looking to eventually retire. And while that does not necessarily mean you'll stop working, it does likely mean a reduction in current and expected income. It also means needing to live on what you will now be generating and protecting that income in principle. The way I look at it, dividends could become my paycheck in retirement, and while pay raises are nice, the paycheck needs to continue to come in even without the raise. That means I look to companies with a history of paying and increasing dividends, as well as sufficient earnings and cash flow from current operations to cover the dividend and grow the business. The company doesn't have to do great or even set records, but they do need to have a stable product line that I'm comfortable with going forward, and the potential upside of longer-term capital appreciation so they can increase the dividend." End quote. So there are some real pearls of wisdom in what he said, and it should be a good confirmation of your dividend strategy to hear from someone who's been focused on investing for 47 years. Okay, now let's jump into the dividend data, and a quick disclaimer is that none of this info should be considered accurate, nor should it be interpreted as buy, sell, or hold recommendations. Plus, sometimes I added my own columns of data to the charts to try to make them more valuable, along with change some headings and such to make it more consumable, and it's possible I misinterpreted some of the data, so use all of this as entertainment only. First, here's a chart of SP500 data over the last 20 years, showing how many companies hiked their dividend, started a dividend, decreased their dividend, or suspended their dividend. Note, I don't believe this includes companies that kept their dividend flat, so in this column where I show you how many companies have a dividend, just realize that it's probably a dozen or so more than this. If we look at year-to-date data, we see that 89 companies have hiked their dividend, 1 initiated a dividend, 4 decreased their dividend, and no one has suspended their dividend so far in 2024. And here are some of the details behind that data. So like the one company that initiated a new dividend this year is Meta, as most of us know. And then here are a handful of the 89 companies that hiked their dividend in January or February of this year, and I hit a bunch of them to keep this on one screen. And there have been 4 dividend cuts in the SP500 so far this year. The first cut listed here is International Flavors and Fragrances that lowered their dividend from $3.24 down to $1.60 in February, which is about a 50% decrease. Here's an article talking about IFF's dividend cut and how their stock fell after they announced weak fourth quarter results, along with the dividend cut, and that they took a non-cash impairment charge of $2.6 billion. An impairment charge is a process used by businesses to write off worthless goodwill, like assets whose value drops or is lost completely. Goodwill is an intangible asset, like your reputation, brand, intellectual property, etc., and assigning a value to goodwill can be challenging. When you take an impairment charge, you often see the balance sheet get reduced, which might occur when something's book value exceeds its fair market value. In fact, a company I'm long in, British American Tobacco, which I wouldn't invest in if I wasn't retired and needing income, recently announced an impairment charge that they took. I got a notification of a new article from Seeking Alpha about it, and saw that BTI had taken a 25 billion British pound impairment charge, which is about 31 billion US dollars. BTI's management basically estimated the useful life in the US of their Newport and Camel and such cigarette products to be 30 years, implying zero value after 2053, which means no cash flow at that point from those products if they're accurate. And that's part of the reason that BTI has a goal of 50% of its revenues coming from non-combustible products in the next 10 years, so think of patches and vaping and the newer stuff that they often say is less unhealthy, such as smokeless products. Now, most of us know that conventional cigarette sales have been in decline in most markets around the world for several decades, so if you invest or want to invest, then you gotta factor all this into your analysis. One thing I like to use to help my analysis are these Seeking Alpha articles in associated comments sections. For example, this person left a comment saying that he reached out to BTI's investor relations team to ask more about the impairment, and he shared what he found out with everyone. These stock articles, along with their comments, are why I value Seeking Alpha so much and paid for it for years. And in case you want, I'll include my Seeking Alpha affiliate link in the description of this video, which often has benefits for new member signups. Anyway, back to the delicious dividend information. On this chart, I added the two columns on the far right side. The green one is the percentage of companies each year that hikes or started a dividend, which I would call good news, versus the red heading, which is the percentage that cut or suspended their dividend, which is often bad news. So like in 2023, 92% of companies had good dividend news versus about 8% that had bad news. In 2022, it was about 99% to 1%. And in 2021, it was again about 99 to 1. But in 2020, aka the year the pandemic hit us, it was only about 81% good versus about 19% bad. And if you look back in time, you can see it's usually over 95% good and under 5% bad, other than when nasty things happen. Like in 2008 when the financial crisis hit us, we went down to 80% good, 20% bad, and then things got even worse in 2009 when we had 67% good dividend changes versus 33% bad. That kind of data should help paint the picture for what different types of economic conditions can do to dividends. Moving on, here's a breakdown of dividend stocks by GICS sector, something that Howard had a hand in creating. There are 11 sectors out there, and some companies can fit into multiple ones. Like, is Disney a communication services stock due to its movies and TV shows, or is it a consumer discretionary due to its parks and cruise ships? Anyway, what we see is that there are 22 tickers in the SP500 communication services sector, and of those, 14 pay a dividend. The average yield across those 14 dividend stocks is low 1.73%. This chart also has columns for mid-cap dividend stocks, which means those with a market cap between $2 billion to $10 billion. Notice that mid-cap dividend stocks have a slightly higher average yield than large cap, which makes sense because they're probably a bit riskier. Howard also had small cap stocks, but I didn't include them here. Looking over these sectors, you can see that utilities and REITs have the highest average yield at 3.7% and 3.8% on average, followed by energy stocks at almost 3.4%. The lowest sector's average yield is information technology at 0.83% average, and all of these sectors and yields make intuitive sense to me. And oftentimes, the lower the yield, the higher the stock appreciation, and vice versa. Of course, every so often a stock will come along which will break that pattern for at least a period of time, like AbbVie's been doing. And then this chart builds off the last one, and it adds in dividend contribution percentages by sector. So like the top 3 dividend-paying contribution sectors in 2023 were financials at 15.71% of dividends, tech at 15.24%, and healthcare at 14.7%. The lowest amount of payouts came from material stocks at 3.23% of SP500 dividend tickers in 2023. This chart also has some yield information that you might want to peruse. Speaking of yields, here's a guru-focused graph of the SP500's yield over time. For reference, I started investing in the 1990s, and you can see how before I started that the yields in the 80s spiked up to almost a 7% average. Crazy. I think it'd be pretty cool if your portfolio was large enough and your expenses were low enough such that the SP500 index's dividends alone could cover your retirement income. Anyway, yields have trended down as the market has shot up, and clearly stocks are going up faster than dividend hikes, and I'll elaborate on that a bit more in a moment. Speaking of dividend hikes, take a look at this. Here we see 13 years of insightful SP500 dividend info. So like in 2024 year to date, the median dividend hikes across SP500 tickers have been 6.45%, and the average increase has been 8.37%. No companies have doubled their dividends so far this year, and none has suspended them either. In 2023, the median increase was 7%, in 2022 it was 8.3%, in 2021 it was also 8.3%, but then in the pandemic year of 2020 it fell down to 6.25%. Then 8.6% for 2019, preceded by an awesome 10% median increase in 2018, 8.7% in 2017, etc. So again, this is some valuable data to get a sense of what dividend hikes or cuts were like in different economic periods. And it helps counter people who say that your dividends get destroyed when the market crashes. I mean, sure, a small percentage of stocks can cut or suspend their dividend for whatever reason, but as we can see, the majority of dividend tickers remain strong, even during the worst economic times. Stock prices definitely got nailed when markets crashed, but many dividend stocks kept pushing onward and upward, which is another reason why I love this strategy. Another observation I have looking at this data is that dividend increases have slowly been trending down over the last decade, which is unfortunate. So a question you might have is, how can you avoid dividend cuts? And probably the easiest way to try to shield your portfolio from being impacted too much by a dividend decrease is probably to focus on dividend ETFs instead of individual stocks. Your payout could still trend down for a bit, but as long as the universe of dividend payouts trends up, which I'll show you that they do normally, then over time you'll probably end up with less negative volatility. And so now take a look at this data that shows SP500 prices, EPS, dividends, and payout ratio percentages, along with yields from nowish back all the way until 1977, which is when Howard started at S&P. I'll just scroll by each page of this data, but feel free to pause the video if you want to see the specifics. It's pretty neat to watch the trends. Okay, now let's minimize the rows between his first and last years of data, thus let's focus on 1977 until the end of 2023. What we can see is that in about 45 years, the SP500 has gone up about 45-fold. That's pretty amazing. EPS has gone up about 16.5 times, and dividends paid out per share on average have also gone up about 16-fold. So as earnings per share go up, then dividends paid out have also gone up similarly. Payout ratio percentage has roughly stayed the same over those years, and dividend yield has gone down by 2/3. So stock appreciation has been spectacular over time, and I found that data to be fascinating. I hope you enjoyed all those insights. I know I did. Now let's switch gears and take a look at Howard's company, S&P Global, ticker SPGI. Here's a cool tool I like on Seeking Alpha that compares the total returns in orange versus the SP500 in blue. This includes dividends reinvested and goes back until 1994. What we see is that SPGI has returned a total of 6,747% as compared to the SP500, which has returned 1,829%, which means that SPGI has beaten the market by an astronomical factor of over 3x. And for reference, S&P Global actually developed the dividend aristocrat methodology that we all use. Let's quickly check what FastGraph says in terms of if SPGI is expensive or cheap right now. What we see is that the black line, which is its stock price, is currently way over both its blue line, which is its market average PE trend line, and is over the orange line, which is the classic market average PE, all of which implies it's quite expensive right now. The ideal time to buy is maybe when the black line dips under the blue and orange lines, aka it's cheap, at least per this tool. It's usually smart to wait and invest when something is cheap, because every stock gets cheap at various points in time, though you may have to wait years to get in. Of course, just because the price is cheap relative to its earnings and historical trends doesn't mean it's a good go-forward investment. Like, take a look at Altria's FastGraph. You can see it's been cheap since 2018 or so, but the reason it's cheap has to do with mounting regulatory hurdles combined with challenging sales. So while it's probably cheap, it also has lots of risks. Still, I really value FastGraphs, and now I feel it's a must-have tool for investors, and I've been paying for a subscription because of that, but I wouldn't blindly buy or sell because of what a tool says. However, it is something I advocate for using. And note, these graphs are available in both the basic and premium FastGraph subscriptions. I'll leave my FastGraphs affiliate link and my coupon code in the description below, and if you use both of them, you can get 25% off your first payments as a new sign-up, whether that's for 1 month or for a full year subscription. Now I want to close this video off and quickly share this article that just came out, talking about things you gotta watch out for in retirement, some of which reinforce why I value dividend income so much. The title is, "I was retired, but wasted big money on these 3 things and had to go back to work." One example they called out talks about how some baby boomers are supporting their millennial and Gen Z children well into adulthood, but it's costing them their retirement. Like a 65-year-old who'd been fully supporting his 2 sons since they graduated from high school, resulting in a $400,000 loss to his retirement portfolio. He was paying for his kids' college expenses and even paid for them to take vacations. And while I think it can be nice to help your adult kids when they're in a bind, you gotta be careful to not go overboard to the point that they seemingly give up and don't try to make it on their own. And that also reinforces that it's super important to live within a budget, and if your budget says you can't cover something, then you do whatever you can to not keep spending. Like, I try really hard to never sell my stocks, even if it's a bit uncomfortable now and then. Another thing the article brought up that killed retiree finances was if they splurged too much when upgrading where they lived. They shared a story of a trucker who'd been driving commercially for over 30 years until he retired, but then 12 years into retirement, they ended up buying a big house with his wife, and that drained too much of their life savings. They became responsible for a mortgage payment that was too much of a burden to deal with, to the point that it sometimes caused them to have to cut back on other important expenses, like their food or gas. Part of the reason they got a house was because they'd grown tired of the rent increases that their apartment they'd been living in kept having, but they unfortunately made a common mistake of buying too big of a house. And the final example the article called out was of a lady who had been retired for a few years, but then was forced back into working because inflation hit her more than she had anticipated. And many retirees haven't financially planned for such dramatic cost of living increases. But as I've shown you in previous videos, quality dividend stocks tend to outpace inflation on average. Your cash flowing income tends to go up more than inflation when looking over time. So that means your buying power often keeps increasing, and it's logical as to why that happens. I mean, if Procter & Gamble increases the price of their products, whether it's Bounty paper towels or Cascade dishwashing soap or whatever, then we consumers obviously feel that at the checkout counter. But it also means that us owners probably get more dividends as revenue and earnings and cash flow also increases. That's part of why you might want to invest in products and services and companies that consumers want and use, and that helps kind of explain why I value blue chip dividend stocks so much. I mean, the reality is that it's becoming harder for most people to afford their day-to-day bills, which means it's also harder for people to invest. And that's why I advocate for people to live frugally, especially in good times. The more you live frugally, the better financial flexibility you'll have, and the more you can invest. We've seen how markets can be crappy for years, and while dividends aren't guaranteed, I think that if you invest intelligently, then you have a strong likelihood of being able to build up new and robust income streams from your investments to help cover you through nasty times. It's best to really push your investing when retirement is far away, especially when you're young and single and hopefully have some disposable cash. Most people who invest eventually say they wish they had started younger, and they wish they'd wasted less money and had invested more. Heck, I wish that, and I've been investing for over 3 decades now. And with that, I'd kindly ask you to hit the thumbs up button, subscribe if you haven't yet, and click the bell notification. Plus share my videos if you don't mind, as that would really help. Also consider joining my channel as a member and becoming one of my OGs. Finally, please join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 80 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.